all CEOs, me included, we don't actually know what we're doing.
They're all sharks, so all you got to do, though, is know shark behavior.
I don't think we've ever talked about this before.
We can capture all of the wallet share.
First place you start is with the product.
That's just the first nut.
This is the Capital Stack. Hey everybody, this is David Paul, the host of the Capital Stack podcast, where I talk to founders, operators, and investors about all things value creation in startups. Today I am talking to Caleb Avery, who is the founder and CEO of Tilled, which is a fintech company, also a PayFac-as-a-service. And we're going to go deep today on payments and payments in the technology world, in the SaaS world, in the marketplace world, and what are these big rails that everyone has? Because quite candidly, I don't know anything about this space except for like it's big, right? So super happy to have you on, Caleb. How you doing today?
I'm doing great. Yeah, definitely excited to talk through the nuts and bolts of payments, and hopefully you'll leave today with at least a little bit better understanding of what's happening in the payments ecosystem, maybe what a PayFac is, and hopefully a good understanding.
Yeah, I just feel like I'm getting fucked whenever I swipe my credit card. Yeah,
that's pretty much what's happening, you know.
Yeah, right. Like there's 5 middlemen that are fucking me, like when I'm swiping my credit
at least
card, right?
there could be 7. It's 3 to 5%. You're not really sure what any of these guys are doing to actually add value in the ecosystem. It's one of those like, tell me what you actually do here, kind of industries where it's like, well, I introduced this person to this person, and I just make 0.5% on every dollar, that's processed, and that's kind of all there is to it.
Yeah, and I'm always suspect when like everyone's sales proposition in an industry is, let me show you how I can save you money. Let me see your statement.
It's
just
unfortunately there's a lot of folks out there that have the kind of cost base. Hey, we're the lowest cost provider out there, and it's like there's no value here. It's just I can save you money. That's really the core value prop that you're going in with. And look, there is, value in saving money, but at the end of the day, I think, merchants and software companies, at least at this point in time, are actually looking for something more than that.
Yeah. So I want to go in, Caleb, I want to know your background, and I want to know your kind of entry point into payments, and tell us a little bit about Tilled after that.
Yeah. So, I started in the payment space at 19 years old, going door to door, selling payment processing services to small business owners, as all 19-year-old college students do. But, started doing the door to door sales. And for me, really got this true understanding of the needs of the individual merchants, and over time scaled up that first company. And then I started consulting for larger software businesses. And so for me, I kept getting brought in on these engagements, typically with a vertical software platform like a dental practice management solution or a golf course management platform. And for these software businesses, oftentimes they were partnering with someone like a Stripe or a Braintree, and they were just passing along the 2.9% and 30 cents from Stripe onto their merchants. And so some of these guys had $400 or $500 million a year in payments volume, and they were making $0 on all of those payments, which was pretty crazy. And so they brought us in to really help them understand, like, how do we actually go about trying to monetize these payments? And it was through that consulting work that I really saw the issues with that side of the business and really the opportunity to build what became Tilled. And so for a lot of these businesses, we were connecting them to gateways like an NMI or authorize.net, and then helping them work with ISOs. And so probably a lot of acronyms that I'm throwing out today. So at any point, kind of stop me and we can talk through, what some of these mean. But
so let's talk about, like, give us the structure, like how, like, I mean, there's like a couple different, there's layers, right? And I from the person that's actually the person taking my payment to the person that's receiving the payment, like, how does that work? Like, in the most layman terms possible.
Yeah, absolutely. So when you're thinking about the kind of transaction cycle and how that flow actually works, when you're at the point of sale buying a cup of coffee and you're going out to get your transaction authorized, there can be, as we talked about earlier in the conversation, a lot of people in the middle of that transaction taking place. And so sometimes that transaction is initiated through a gateway. And so that gateway is literally the middleman, connecting the point of sale, solution to the acquirers and the card brands to authorize, that transaction. And the crazy thing is that sometimes there's another middleman in the middle of that, being the ISO or the agent in between on that sale. And so that ISO or agent is selling, the coffee shop access to that gateway, to that terminal.
Yeah, so the ISO is like a distribution model,
transaction, right? Essentially, I think for most of the large banks and the large processors, they found that the ISO or the 1099 distribution model was an incredibly lucrative model for them, because it was eat what you kill. And so for an agent or an ISO that's out there on the street, they're not getting paid unless they're bringing business in the door, but they're getting a percentage or a commission on every payment that's processed through the merchants or the software platforms that they're bringing to that bank or to that processor. And so at the end of the day, you've got, at this point, there's a decent number, a couple dozen of these companies that have the direct connections into the card brands that actually process, authorize, and settle the transactions to the merchants. And then you've got the card brands, you've got the acquiring banks, you've got the issuing banks, and everybody plays, their own role in the ecosystem, making sure that when you go in and swipe, that card to buy that cup of coffee, the money transfers from your bank account through this, series of middlemen to get to, the merchant's bank account, because that's ultimately, the point is connecting the cardholder and the consumer to the merchant, providing, the good or service. And there's a lot of people that, are in the middle of the transaction, essentially ensuring that transaction flows smoothly and guaranteeing that those funds are available and going to that merchant.
So, I can understand the distribution model, right? And spiffing people for that work and providing the technology to take the payments. Where does risk sit in this value chain? Because, I hear terms like KYC, know your customer, on risk, off risk, who's taking the, percentage of risk. How does that play into this value chain?
Yeah. So when you think about the risk in this space, it does differ whether you're talking about that traditional ISO model or more of the PayFac model, like we're leveraging here at Tild. And that traditional ISO agent model, it does depend on if that ISO is operating in a retail or a wholesale ISO capacity. If they're operating as a wholesale ISO, then they're taking on the risk and the liability. They're going through a registration process with their banking and processing partners. But typically it's either sitting on the ISO or the processor. But at the end of the day, it's sitting on the bank that's facilitating the funds, through the ecosystem. And so in all of these cases, you have to go through an underwriting process with a sponsor bank to go through that registration process to ensure that you have the personnel, the technology, the policies, the procedures, the balance sheet to be able to actually absorb that risk. Under the payment facilitator model is a little bit different, where in that traditional ISO model, each coffee shop, each merchant is getting their own merchant ID, their own merchant account to process those transactions. Whereas under the payment facilitator model, that PayFac goes through some very intense scrutiny with the banks, the processors, the card brands. And, typically you're talking about a 6 to 12 month process to go through, that diligence exercise where the payment facilitator becomes what's called a master merchant. And the beauty of that model, companies like Stripe, Square, Braintree, PayPal, Toast are some of the more notable examples of companies that have gone through that PayFac process. And the advantage is once you've gone through that process and you assume the liability, you're then able to create this instant digital streamlined boarding experience for all of the sub merchants that are coming under your model. And you contrast that to, emailing a PDF application out to a merchant and collecting a driver's license and bank statements and all of the supporting documentation, where it's a very heavy underwriting kind of manual intensive process to create that merchant account under that traditional ISO model. Whereas in this payment facilitator model, it's really been streamlined, at least from the merchant experience perspective.
Yeah, but because you're putting this infrastructure in, I'm not talking about Tild, I'm talking about pre-Tild, right? Becoming a PayFac. There's a ton of 6 to 12 months. There's an expense. There's an investment, a capital investment that needs to be made.
Absolutely.
There's a balance sheet you have to have. So, what is the processing volume that typically would make sense for an investment like this?
Yeah, I would say, in my opinion, when I think about the integrated software payments landscape, I think about it in three segments. I think about 0 to 50 million being kind of the startup segment, 50 million to 2 billion being kind of the mid-market, and then north of 2 billion, where, in my opinion, 2 billion a year in annual processing volume is really the economic breakpoint, where economically you can argue that it really makes sense to go look at, becoming a fully registered payment facilitator. I think for me, I went through a consulting exercise with a software company doing about $1 billion in payment volume, and they were just dead set. They were convinced that them becoming a PayFac made a ton of sense. And then as I started to educate them on the technology, the personnel costs, the liability losses, PCI, card brand registration fees, they're like, wait, we need all of those things to be a registered PayFac? And it's like,
Just
yeah,
kidding.
you do. And they're like, oh, so we're actually going to make less money than in this referral relationship than we have today? And I'm like, bottom line, yes, like your top line revenue will be higher, layer in all these costs, and then at the end of the day, you're actually making, less money. And I think that's one of the misconceptions that exists in this space is, you've got a lot of these companies that are touting the top line revenue number. And look, nothing against the top line revenue number. There's just a significant amount of OpEx that's required to actually operate, as a PayFac. And that's not even taking into account the actual like additional expenses, legal, the development costs, shifts in your go-to-market strategy, the additional support costs that you need to have in place to really do that model well is incredibly capital intensive. At scale, it makes a ton of sense and is highly profitable. When you're Toast, Shopify, MindBody, these kind of mega, software platforms, it's a no-brainer. Like it's a no-brainer, for those guys. But, a software business doing 50, 100, 200 million a year in payments volume, I mean, you're almost crazy to even consider, going down that path unless you're going to, 100 extra volume in the next, 18 months. And then, if you are, God bless you anyways.
Yeah, right. You have bigger fish to fry. So, so what is Tilled? Is Tilled offering like a lighter version of this? Like, how does Tilled play into this?
Yeah. So for me, after going through all of this consulting experience and really understanding the kind of rub when it came to the downsides of the experience to go become a PayFac for these software platforms, I really had this vision of like, how do we help more of these software companies leverage the benefits of this payment facilitator model that has so many advantages relative to the traditional ISO world that I came from, but not having to go down all of the regulatory and compliance paths to become a PayFac themselves. And so fundamentally at Tilled, we provide a turnkey white label payments infrastructure solution to software platforms so that they can come integrate to our APIs and SDKs. Our average integration is about 11 and a half days. They're not hiring a team. They're not taking on additional liability, but we're still paying them the lion's share of the revenue on all of the transactions flowing through their platform. So substantially easier to get up and running. There's none of the OpEx or the downsides associated traditionally with the PayFac model, but you're still earning the lion's share of the revenue on all of those transactions flowing through your platform. And so it's kind of the best of both worlds between the different models that are available.
It's kind of like in the middle, right? Right in the middle.
Mm-hmm. Yeah.
And so, what's the revenue threshold that you think that a Tilled makes sense from going from an ISO model to like a partial PayFac or outsourced PayFac?
Yeah. So when I think about the kind of Payfac-as-a-service sweet spot, it's really that mid-market lower enterprise. So that 50 million to 2 billion a year annual processing businesses where there's enough volume that it really makes sense to want to monetize the payments, but you're nowhere near that scale that you can really justify the idea of becoming your own PayFac yourselves. And it's not to say that we don't work with startups and we don't recommend, startups taking a look at Tilled. That's probably about 20% of our book of business, but it's not our core focus. And I think for a lot of these startups, they really have to decide, like, is this really where they want to spend, their effort, in the early days. That said, I think as the capital markets are shifting and capital is getting harder to come by, you're actually seeing that threshold go further, down the market, where I'm sure from the seat that you're sitting in, the traction and revenue thresholds that the companies need to achieve to get the valuation expectations that they want have shifted over the last, 12, 18 months. And so you're seeing earlier stage businesses understand that margins matter, profitability matters, average revenue per unit, matters. And if you can implement all of those things in a couple of weeks with a provider like Tild with no upfront costs, no ongoing OpEx, it's actually a pretty attractive model, even for companies that traditionally, we would have thought might have been a little bit small, to come to Tild. We're seeing more and more of those guys coming to us.
Yeah. So it is, even just for the education piece, it's worth the call, because as an early stage company, to understand this web of intricacies and margin profiles that really go all the way down to the basis point, right, on these transactions, to really get a good idea of their own unit economics in their business.
Well, and I think more and more investors are understanding the value of integrated payments. I mean, there's a ton of, private equity and growth equity shops out there who have entire, strategies around investing or acquiring, these software businesses, layering in payments and potentially doubling or tripling the margin, within these businesses. And so a lot of founders are starting to understand, the potential magnitude of the impact that, creating that payment monetization strategy, can have. Where, look, if we're saying, hey, you're going to add 2%, to your revenue, that's not all that exciting. But if I said, hey, you could double your revenue in the next, 3 to 6 months, that actually gets people's attention to want to come take a look at, how to think about layering in that payment monetization, strategy to their business.
Yeah, this, I'm going to, a little anecdotal story. I couldn't believe this. So there was a software company CEO that I was talking to, vertically HR software, right? For a specific market segment. He runs about 1.8 billion in processing payments, right? So kind of on the upper end of that of that market. He told his PayFac, because he's not a PayFac, that he was going to withdraw and change his whatever, in 12 months, right? Because he's contracted for 12 months. They gave him $350,000 cash, as well as 5 salespeople to sell on behalf of him to his customers in order for him to extend his contract. I mean, I just couldn't believe that. That's a lot of money, dude. That's a lot of fucking money.
I think, my experience, there's a lot of companies out there that have been able to really take advantage of a lot of these vertical software platforms that really aren't payments experts. They don't understand, well, should I be making 5 basis points, 50 basis points, 80, what's a fair share, of this revenue? And, let's take Stripe, as an example. They're going to start you out at 2.9% and 30 cents. And, they're going to graciously negotiate down to 2.75% and 25 cents. Well, you still don't know what Stripe's margin are. You don't know how much money you're leaving on the table. And then you come, talk to someone, like myself, or bring in a consultant. You're like, we're leaving 75 basis points on the table on, whatever is 500 million, $1 billion a year in volume. And you're like, wait, we could make an extra 5 million a year in pure margin straight to our bottom line. Like, what the heck are we doing? Continuing to run, all this.
And I guess that's when the 350 grand doesn't really matter, right?
Yeah. But, look, I don't blame them for trying to retain, their customer. I'm sure it's still a highly profitable relationship, for them. But I think, for us, a big part of our mission here at Tild is this idea of changing the payments landscape for the better, where, look, it's a highly profitable business, but there's a lot of people that operate in this idea of kind of secrecy and, hey, we're going to tell you kind of half of the information that you need so we have an upper hand in the negotiation, whereas our approach is more educational, consultative. Even if we're not the right fit for your business, if we can help give you a better understanding of the landscape, the ecosystem, what's fair, what you should be asking for, the questions that maybe you didn't even think about that you need to ask of your current provider or other providers that you're evaluating, we want to make sure that these software businesses really have, experts that they can turn to make sure that they're making the right decisions for their business, even if that means that Tild isn't the right fit, for their business.
Yeah. So when this market was on its way to, I guess we could call it the top, right? Before this correction happened, I just felt that this margin pressure on SaaS products was just insurmountable. People were just getting pushed down to the bottom. And I had this feeling, because, you see these variable type, revenue models where it's partial payment volume or transactional volume off the payments, and it's partial SaaS. And I was thinking of a world was there ever going to be a world where, the software people just didn't charge for the software, but they were just charging for payments, and like that was essentially the lock-in. Because you're I mean, like
we have customers that do it today.
The software just keeps you in, right? Like it literally is just what keeps you sucked in, but everything else is just payments.
Yeah, I mean, we have a software partner that was charging, I think it was like $89.99 a month for their software fee. They discounted it down to $19.99 a month because they're making $150 a month on the payments margin. Like, it's a no-brainer for them to discount, that core, software fee, or frankly give it away, which is what I think we were recommending, in that equation. But look, that if you can make more money on the back end, through the payments, and ultimately go acquire more customers and, create a better experience, for all of your partners, why not? And I think from a competitive landscape perspective, part of the reason why you're seeing, more of that margin compression on the SaaS products is because some of the bigger competitors have figured out how to effectively monetize the payments, and they understand that they don't need to charge such a premium for the SaaS product itself, and then they're gobbling up market share because they're making money on 2-3 product lines, whereas some of the smaller businesses that haven't figured out how to layer in that payment monetization strategy, their only option is the SaaS fee.
Mm-hmm. Right, exactly. So since you obviously you're a very customer focused, product focused company based on how it seems like you interact with your customers, so how do you advise founders, right, just on that appropriate mix of transaction fee versus platform fee?
Yeah, I mean, look, I think
there's a balancing act there, right? And it kind of moves back and forth, and so how do you think about that?
It does, and I think for me, the advice that I was given, the kind of path that we took, and the advice that I tend to give to founders is really focusing on customer discovery and getting that feedback from your customers. You can't make these decisions, in a vacuum. You have to go out there and test the market, talk to customers, and really get that feedback from the people that are ultimately making the buying decision, on your product, and really see, what price the market, can bear. And for me, in the early days, we were out there talking to as many customers as we could to understand, like, why are the business models that our competitors, have implemented not working? Frankly, we were out there talking to dozens of these companies, and it was something crazy. Like, the first, we talked to, call it 36 customers, and 80% of them had talked to both of our kind of top 2 competitors in the space, and decided that they didn't want to work with either, of those competitors. And it was this incredible market insight where they felt like the business model was confusing, and they felt like the time to market was going to be a huge constraint for them. And with that feedback, it's like, okay, well, I know exactly, what these issues are, that my competitors are facing. And if I can go tackle, these couple of problems, then, I feel like we're going to be able to kind of cross that chasm and build something, that can sustain, in the industry. But I think for a lot of founders, they're either nervous, to go out there and do that, or, feel like, it's weird to go kind of have those conversations, with customers. But I think for me, my background was door-to-door sales. Like, I'll go out and talk to anybody about exactly. Anything. Like, the worst case, it's a horrible, experience, and you don't talk to that person, again. I also think for me, especially in the early days, when I was doing this customer discovery process, it wasn't selling. Like, I was genuinely wanting feedback, from our customers. And what surprised me was how willing other founders, other business owners were to provide really candid feedback. And some of it wasn't always fun to hear, but like founder to founder, when they didn't feel like, I'm not here to sell them. I'm not saying, hey, I've got a much better solution, for you. I'm like, I genuinely want feedback on, why did this other solution not work for you? Why are you unhappy with the solution, that you have today? And we were able to get some incredibly valuable, candid feedback just by having that open dialogue where we're not selling to them.
Nice. So what's in store for Tild? What are you excited about? What's the next 2023 look for you?
Yeah. So, when I think about 2022 for us, we proved without a shadow of a doubt, we can attract, sign, and launch, software companies onto the platform, and just incredibly excited with the momentum, that we've built up. 2023 for us is really about scaling and really, focusing in on these customer relationships, lending sales resources to our partners, to help them scale. Like this week, a couple of our sales guys are at a conference, helping one of our customers go close merchants. And so we're really leaning in with a lot of our larger partners to help them, really scale up their businesses, because we all benefit, from that. I also feel like, for me, we're starting to see more and more interest from, some of the larger players in the space that are excited about, white label or licensing opportunities, at Tilt. And so we're starting to explore, these relationships where we've really built industry leading technology focused on ISVs, whereas a lot of the traditional processors have always focused on the merchant experience. You go back to what we were talking about in the beginning of the conversation with that traditional agent ISO distribution model. Well, that distribution model is changing, and it's changing at a pretty incredible pace in favor of software-led payments being the primary way that SMBs are getting access to payment processing. That's the highest growth category within the entire payments ecosystem. And so a lot of the traditional players that don't have a very good ISV, software-led experience are kind of looking at the numbers saying, hey, this cash cow side of our business is really not growing, whereas, this software-led payments side of the business is really taking off. And I think, with the technology that we built, there's an opportunity to kind of marry, those two worlds together. And I'm really excited to see where that side of the business goes over the next year.
That's awesome, man. That's awesome. A couple canned questions before we finish off today. What is your favorite book?
Favorite book, I would say Peter Thiel, 0 to 1. The idea that, to build, something truly meaningful, you can't just have a small tweak, on an existing idea. You really have to start something new. And for me, that started with creating the idea of PayFac-as-a-service. Like that category, that nomenclature, that name did not exist, prior to Tilt. And so for us, we're setting out to do something that's never been done before. And that's not easy, but it's a whole lot of fun.
That's great. That's great. What's the best piece of business advice you've ever had?
So I'd say about 2.5 years ago, really started to understand the benefit of personal branding. That was just a concept that was completely foreign, to me, where, around the start of the pandemic, we were really trying to figure out like what the go-to-market strategy was going to look like for Tilt, where, trade shows weren't happening, people weren't meeting, in person. It was just a completely different environment than what I was used to and what we had planned for, and started to read up and speak to some folks that were having a ton of success on LinkedIn, selling B2B products on LinkedIn. And for me, that was just this completely foreign concept. But as I started to dig in and really understand more about the value of personal branding, it's become an instrumental part of the go-to-market for us here at Tilt. So if you're a founder, don't sleep on the power of building your personal brand online. It can do incredible things for your business, but it does take time.
Yeah, it does take time. It's sometimes you feel like you're speaking into a vacuum.
For like a while, like I'm 2.5 years into the journey.
I'm glad you got on this podcast, because literally no one's listening to it right now. So.
Yeah, yeah. The first year was kind of me talking to myself on LinkedIn, and then it started to get a little better, and then a little better, and now it's a huge part of the go-to-market motion for the business. But it takes that dedication and that willingness to kind of evolve and stay dedicated to something that you're not going to see immediate results from day one.
And you have to even though you have to kind of enjoy what you're doing, whether it's like writing or doing videos or podcasting. Like for me, I do a blog about 4 times a week. I do a podcast. I do a LinkedIn Live once a month. And I made a rule to myself, the first time that I start feeling like this is work, I'm out, right? I don't want to do it. But I only talk to people I want to talk to. My blogs are literally, you can finish them in 45 seconds. It's literally the least amount of value you can ever have in a blog. I mean, it should be a tweet. It's not it's the worst content ever, but I do it, right? And people are subscribing to it for some fucking reason. But
I think that part about having fun is incredibly important. I also think you can't put pressure on yourself. Like for me, I haven't posted in a week, and I kind of feel bad about it. But it's I just wasn't inspired to post, during that time period. And I'll probably post the next 7 days. And so, it's like you have to give yourself the space to, do what feels natural, do what feels right, take a break when you need to take a break, but have some fun. And I think I would tend to agree. Like the podcasts for me are a ton of fun. I just love doing these. We do a blog a week, and that's a ton of fun for me. And I love sharing the journey, online with folks, and generally, the feedback's been pretty positive, which is encouraging.
Awesome. Well, thank you so much, Caleb. It's great having you on. Everybody, thank you so much for tuning into the Capital Stack, where we learn about what's going on in tech. We learn about the trends. We try to get just a little bit smarter on how the world is shaping and where the puck is going. You can find us on all major platforms, YouTube, Spotify, and Apple. If you like it, share with a friend, comment, cancel me, do whatever. And I will see you next week. Thanks. Bye-bye.
Thank you for tuning in to the Capital Stack Podcast. Make sure to share this with someone you know that can benefit from this content. Remember to support this show by rating, reviewing, and subscribing. David Paul is the founder and general partner at DWP Capital. All opinions expressed by David and podcast guests are solely their own opinions and do not reflect the opinion of DWP Capital. This podcast is for informational purposes only and should not be relied upon for decisions. David and guests may maintain positions in the securities discussed on this podcast.